Hello and welcome to the Deep Dive. Today we're taking a close look at the dynamic, rapidly evolving world of digital assets. Our deep dive is anchored by a really insightful article from Justin Arzodon over at BetaShares. It's titled, "What is the Innovation Exemption and Why Does it Matter?" So we're basically setting the stage to explore some truly crucial developments in crypto. Think regulatory shifts, market dynamics, and even specific companies making some really bold moves.
Exactly. And our mission for you, our listener, is to pull out the most important nuggets of knowledge from these sources. We want to make sure you understand not just what's going on in this fast-paced space, but why these developments are so critical for the future of finance, of technology. Think of it as your efficient shortcut to being genuinely well-informed, cutting through some of the noise.
Okay, so let's unpack something that could really be a game changer. The U.S. Securities and Exchange Commission, the SEC, they're actively considering something called an innovation exemption. SEC Chairman Paul Atkins has suggested policy here. It's aimed at easing regulatory barriers for decentralized systems and, crucially, protecting developers from potential, overreach. Sounds pretty significant.
Yeah, it is. And what's compelling about it is the intended purpose. It's meant to directly align U.S. financial regulations with all this Web3 innovation that's happening. If it goes through, this could unlock quite substantial growth for blockchain platforms. Atkins was pretty clear on his point, too. He argued that, software developers building these DeFi tools, they shouldn't be held accountable for how others end up using those tools. He emphasized these applications are designed to work autonomously without a central operator. It's a subtle but very important distinction.
Right, DeFi, just for clarity, that's decentralized finance. Basically, blockchain systems providing financial services using code, not traditional banks or brokers. And that distinction you mentioned, that's where it gets really interesting, isn't it? This kind of exemption could really reshape how innovation happens in DeFi. It could provide a much clearer path, less murky than the regulatory uncertainty we see now. But here's the tricky part, I guess. Atkins argues developers shouldn't be blamed for misuse. But how do regulators actually draw that line? How do you ensure accountability for, say, bad actors or misuse without totally stifling the innovation this exemption is supposed to protect?
That's the million-dollar question, isn't it? That's the real challenge. The idea is to foster this permissionless innovation, but you're dealing with a global, borderless financial system built on code. That brings up all sorts of complex questions about oversight, responsibility. It really boils down to finding that balance, enabling the tech while safeguarding the market.
Okay, so from these potential regulatory shifts, let's maybe zoom out for a second. How's the broader crypto market actually reacting? Let's take a snapshot from mid-2025. So looking at the week leading up to June 22nd, Bitcoin was down a bit, 92.83%, trading around $102,491. Ethereum saw a bigger dip, actually. It was lower by 10.22% at $2,271. And the overall global crypto market cap stood at about US $3.14 trillion. Bitcoin's dominance was still pretty strong, though, 64.9%.
Yeah, and the source mentioned that some of those declines were partly put down to broader macro risks. Specifically, the ongoing conflict between Israel and Iran was mentioned, which just underscores how interconnected everything is, right? Even digital assets, even in a decentralized space, geopolitics can ripple through and affect market sentiment prices. It's a good reminder that crypto markets definitely don't operate in a vacuum.
That's a great point. Okay, so we've talked policy potentially opening doors for DeFi. Let's pivot now to something acting as a bridge between traditional finance and digital assets. Stablecoins. And a pretty significant move by Visa here. They recently announced plans to expand their stablecoin settlement capabilities. We're talking Central and Eastern Europe, Middle East, and Africa. So CMEA. And this involves a new partnership with Yellow Card, which is a Pan-African fintech. The goal seems to be experimenting with stablecoins in licensed African markets for things like treasury operations, boosting liquidity.
And if you connect that to the bigger picture, Visa's strategy is quite telling. They clearly seem to believe that integrating stablecoins into global payment systems isn't just like an optional extra. They see it as an absolute necessity for the future of moving money, which implies that pretty much any major company involved in global payments will probably need its own stablecoin strategy sooner or later.
Yeah, that makes sense.
It definitely raises an important question, though. Are the traditional financial institutions moving fast enough and, comprehensively enough? Are they really adapting to this digital asset landscape? Or are some maybe still underestimating just how fast this shift is happening?
Good question. And speaking of adaptation, let's maybe shine a spotlight on a specific company, MetaPlanet. Now, this is a really intriguing case study. This company used to be a budget hotel business called Red Planet Japan. But after COVID hit back in 2020, they did this dramatic pivot, full pivot towards crypto, Web3, NFTs.
It's incredibly aggressive, almost audacious, you could say. MetaPlanet now holds, get this, 10,000 Bitcoin. That makes it the 9th largest corporate holder of Bitcoin globally.
Wow, 10,000.
Yeah. And their ambition doesn't stop there. They're targeting 100,000 Bitcoin by the end of 2026 and an incredible 210,000 Bitcoin by the end of 2027.
Huge.
It is. And this bold move, well, it's certainly paid off for them so far. Their stock price shot up over 1,600% in the 12 months leading up to June 23rd, 2025. So this isn't just, a company adding some Bitcoin to its balance sheet. This is a former hotel business betting its entire future on basically a single asset class. What does that kind of dramatic, super aggressive pivot tell us about the conviction maybe emerging in unexpected corners of the corporate world? And could this kind of daring reinvention be, a blueprint or maybe a cautionary tale for other industries looking to adapt?
That's a really fascinating point. It definitely highlights the high-stakes nature of these transformations. And just for those of you who track the space closely, it's worth noting MetaPlanet is actually a holding in the BetaShares Crypto Innovators ETF. That's on the ASX, ticker CRYP. Gives exposure to global companies really at the forefront of this crypto economy. Okay, let's shift gears a bit. Let's dive into the blockchain data itself, kind of decode Bitcoin's on-chain metrics. We'll look at two specific indicators here that offer some pretty deep insights into investor behavior. HODL waves and something called UTXO, realized price distribution, or URPD.
Right, let's start with HODL waves. So basically, this metric uses the blockchain data to show how much Bitcoin is in circulation, grouped by how long it hasn't moved. Looking at the data from June 21st, 2025, about 37.9% of all Bitcoin moved sometime in the last year. But here's the really interesting part. 31.48% hasn't moved in 1 to 5 years, and roughly 30% hasn't moved in more than 5 years.
30% for over 5 years. Wow.
Yeah, that 30% that's just been sitting there untouched for over 5 years. It's not just a number. It kind of represents this bedrock of, diamond hands conviction, as they say. It suggests a really significant stable chunk of the supply is held by investors with an extremely long-term view, which, could act as strong support in downturns, or conversely, it could be a major source of selling pressure if that conviction ever changes. It's a critical dynamic for market stability.
Okay, that makes sense. And the second metric, UTXO.
Right. UTXO realized price distribution, specifically the AT partitioned version. So this one shows us the prices at which existing Bitcoins last moved on the blockchain. As of June 22nd, 2025, roughly 5% of Bitcoin's unspent transaction outputs. Those are the individual chunks of Bitcoin. They were created when Bitcoin's price was between $104,123 and $105,242. And the source interprets this as suggesting potentially a stronger price floor building up around those levels.
Interesting. Using the chain data itself to spot potential support.
Exactly. It's a powerful example of how analyzing blockchain data is, evolving how we understand market dynamics.
Okay, shifting our focus slightly again, let's look at altcoins. Now, while most of the top 20 altcoins were actually down in that week leading to June 22nd, there was some genuinely positive news for one major player, XRP.
Indeed, there was. Canadian regulators approved a spot XRP ETF. It actually started trading on June 18th up on the Toronto Stock Exchange. The ticker is TSX.XRPP. And this is pretty significant because, XRP is currently the 4th largest crypto by market cap, sitting around $123 billion at the time the source was written. So getting a spot ETF approved for an altcoin of that size, it could definitely open doors for broader institutional adoption. Not just for XRP, perhaps, but maybe for other major altcoins down the line. It might signal, increasing regulatory comfort, at least in some places.
Well, this has been quite the deep dive today, really illuminating. We've covered such a wide range, haven't we? From potential huge regulatory shifts like that innovation exemption, which could fundamentally change DeFi, right down to the nitty-gritty of on-chain metrics, showing us what's really happening under the hood with Bitcoin. And then these real-world examples, like MetaPlanet's incredibly bold strategy.
Absolutely. And as always, it's really crucial we remember the important caveats, the warnings from the source material. Investing in crypto assets is, let's be clear, considered extremely high risk. It is speculative, it's highly volatile, it's definitely not suitable for all investors. You need an extremely high tolerance for risk, and frankly, the capacity to absorb a rapid loss of some, or maybe even all, of your investment. Any exposure to crypto really should only be a very small, carefully considered part of your overall portfolio.
Vital context.
Yeah. Understanding these significant risks is just as important, maybe more important, than understanding the potential opportunities before you make any decisions.
Well said. Okay, so as regulation, technology, and adoption keep evolving at this, well, breakneck speed, here's something to think about. What new frontier in digital assets do you see as the next major area for innovation or investment? And how might that next frontier be influenced by policies like this potential innovation exemption? Something to ponder until our next deep dive.